Healthcare costs are on the rise, but so is the opportunity for smart investments. Multiplan is one of these companies fighting the good fight. They are a healthcare technology company that has been revolutionizing the healthcare industry for over 40 years. Founded in 1980, Multiplan has been a leader in supplying innovative solutions to healthcare providers, payers, and consumers. From my research, they are the underdog fighting against the unstoppable rise of medical costs. You don't have to look far here about examples of the insanity of medical costs in the US. People would rather take an Uber than request an ambulance. That is the fight they are trying to have. At first, the company was met with skepticism from many in the industry. After all, Multiplan is trying to take on giants in the industry like United Health Group, Aetna, a subsidiary of CVS Health, and Cigna. I always love an underdog story, especially if they are fighting for a worthy cause. Since listing, they have become one of the most successful companies in the healthcare space. The company has been solid over the past 3 years, recovering profit levels and keeping cash flows positive. Even with their success, their share price has dropped well below its IPO levels. Because #analysts. Trying to understand the products they offer is challenging. According to what I have read, their software solutions include network solutions that help payers and providers manage healthcare costs by providing access to a network of healthcare providers. Payment integrity solutions help identify and prevent healthcare fraud, waste, and abuse. Analytic solutions provide data and insights to help payers and providers make informed decisions about healthcare costs. Clinical solutions help payers and providers manage the clinical aspects of healthcare costs. The solutions include case management, disease management, and care coordination. Reading this might sound like reading an instruction manual to assemble furniture. But all you need to know is that they combine these products and solutions to create custom solutions based on customer needs. Since its humble beginnings in 1980, they have grown and become a solid business. Starting with a group of healthcare professionals and entrepreneurs feeling that there is a better way of doing things. Following its start, it has grown, facing many challenges on the journey, especially with competition. Let's have a look at how the company has grown over the last few years. For any story of growth, you have to talk about the origins of a company. Finding the story of their origin is challenging. According to ChatGPT, it was a guy named Joe with no surname. Not quite the answer I was looking for. Even though their beginnings are mysterious, they burst onto the scene as a SPAC deal in 2020, merging with Churchill Capital Corporation 3. Since then, there have been 2 key acquisitions and mergers that have helped to further its growth. In 2020, the company acquired HST, an innovative healthcare technology company that enables value-based health benefit plan designs, for a purchase price of $140 million. With the acquisition of HST, they gain comprehensive front-end engagement tools for reference-based pricing, RBP, and are better positioned to deliver more value to healthcare payers, consumers, and providers. In 2021, Multiplan acquired Discovery Health Partners, Discovery, for $155 million, a leading provider of healthcare cost management services. By spanning the claims lifecycle and ensuring the legitimacy of a payer's payment requests as well as premium collections, Discovery Solutions will supplement and extend their payment integrity offerings. Acquiring companies to enhance their offering has been their game, which has bode well for their financial performance. Let's have a look at the financial performance of Multiplan. Financial performance is a given for a solid performer like Multiplan. Third quarter 2022 financial performance was a mixed bag. While revenue was down 13% from the prior year quarter and adjusted EBITDA was down 21%, CEO Dale White expressed optimism that patient utilization could begin to recover more broadly and that they were taking steps to prepare for it. He also noted that there are no material covenant issues coming up and that they have flexibility as they navigate through a soft patch. To manage the business through these more challenging market conditions, Multiplan is implementing initiatives with customers to help them cope with accelerating healthcare costs, developing new products, reviewing their long-term growth strategy, and undertaking internal cost-saving initiatives. They are cautiously optimistic that patient utilization could begin to recover more broadly, but they do not expect the market softness to persist into 2023. Overall, Multiplan Corporation is taking proactive steps to ensure that their services remain competitive in an ever-changing healthcare landscape. Investors will be watching closely as the company continues to implement its action plan over the coming quarters. But they face some risks to their financial performance. They must overcome several risks to stay on the growth path over the next few years. One of the biggest risks is competition from other companies in the healthcare space. As more companies enter the market, they will need to continue to innovate and differentiate themselves to remain competitive. The company also faces the risk of changes in government regulations and policies. These changes could have a significant impact on MultiPlan's operations and profitability, as well as its ability to attract new customers. Finally, they also face the risk of technological disruption. As technology continues to evolve, they will need to stay ahead of the curve to remain competitive. This means investing in research and development and staying up to date with the latest trends in healthcare technology. Considering these risks, we jump straight into the valuation. Using a nifty tool from Simply Wall Street, I can look at the trends they are forecasting. Then quickly perform a valuation in an attempt to see if there is a gap between the share price and the valuation. Model assumptions are: discount rate, 12% due to the high-risk nature of MPLN being a micro-cap company. Perpetual growth, 3% based on market trends. Just based on this analysis, I value them 22% over the current share price. It's also a good idea to look at some of its peers and how they stack up together. Here the Simply Wall Street tools come in handy. From this analysis, MultiPlan is heavily undervalued considering its peers in the same industry. Overall, MultiPlan has done an impressive job of managing these risks over the past 5 years. But investors do not like the healthcare technology space. What makes matters worse is that they became public as a SPAC. Even with these setbacks, the company has continued to innovate and differentiate itself from its competitors, while also staying ahead of changes in government regulations and technological disruptions. This has enabled it to remain competitive and continue producing good cash flows year after year. Definitely a stock on my buy list.